On September 18th, the Federal Reserve reduced its federal fund rate for the first time in 4 years, reducing its target rate by a half percentage point. Did this announcement have an immediate positive impact on Irvine's residential housing market, or did it continue its downward trend? This announcement, combined with the recent drop in mortgage rates, has led to the first increase in detached single-family home sales in Irvine in 5 months. In September, we saw 63 homes sell, which was up from the historically low 51 homes that sold in August. This boost in sales is pretty unusual for this time of the year. Historically, we'll see overall demand levels and total home sales slowly decrease through the back part of this year. However, with the Fed's positive announcement combined with mortgage rates lowering, improving home affordability, we have seen more buyers come back to the market. As a result, we saw overall housing demand levels increase by 10% in Orange County in the month of September. And this was the first increase in demand for the month of September since 2012. Despite the impact lower rates had on demand levels, housing supply levels stayed pretty much unchanged. The amount of detached single-family homes for sale in Irvine slightly decreased from an average of 203 in the month of August down to 202 in the month of September. However, we should see this number fall off a little bit more quickly as we enter quarter 4. In theory, when demand levels increase and supply levels remain the same, if not decline a little bit, we should see pricing increase. However, that was not the case for Irvine this last month. The average price per square foot of a detached single-family home continued to decline slightly, settling in at $931 a square foot for the month of September. Similarly, the average sales price dropped down to right around $2.757 million. While this price drop contradicts basic economic principles, it aligns with historical patterns. Prices often decrease towards the end of the year as demand levels fall off. However, the question at hand this year is, will these lower rates bring enough buyers back to the market, pushing up demand and ultimately increasing prices by the end of this year? Well, a promising sign came this week as the Federal Reserve announced that they are forecasting 2 more rate cuts totaling another half percentage point are likely to come before the end of this year. However, other factors such as the 10-year Treasury bond, stock market performance, and other economic indicators will play a huge role in how mortgage rates respond to these potential cuts. If mortgage rates continue to fall, we should see demand levels continue to increase, which will likely lead to higher home prices to end 2024. If the market takes a little bit longer to respond to these lower rates, we are still looking at a likely very hot start to the market in 2025. So let me know in the comments below, where do you think Irvine's housing market is headed for the last part of 2024 and into 2025? If I don't hear from you, I look forward to getting to bring you your next Irvine housing market update. Cheers.